Everybody, Marty Mazzora here. Good morning, March 2nd, 2018. Coming to you once again with a video commentary. Of course, there's a new concern out there, and that is the concern of protectionism. We'll do some more work on that over the weekend, and I'll offer up some more market perspective on what that means. Right now, let's just talk about where we are, and let's take a look at the chart that I presented to you back on February 5th, courtesy of Bespoke Investment Group. And the red line is the correction at the time. It was the fifth occurrence of a 7% decline over 7 days, and there's where we were on that day. What we showed you here was that there was only one exception, and that was the second occurrence in 2011, where the market didn't come back and at least get very close to testing or breaching the actual level that it reached on that day. So to bring you up to speed or up to date, here we are as of yesterday's close. Here we were on the 5th of February. So we came up, came back down, found a new low there, have come up since then. And another couple hundred points on the Dow. This happens to be the S&P 500, and we're beginning to test that level that we found back on February 8th. Now, right about in here, February 27th, we said that we should expect the market to take back recent gains and some. And again, folks, that was several days before the president's tariff announcement of yesterday. A little further back on February 12th, we said those of you who prefer to see the present correction end sooner than later will like how the market at least opens this morning. Those of you who understand that corrections amid a strong overall setup are the healthiest of things might prefer that it last a bit longer and purge a few more excesses. I, by the way, would be in the latter group. And here's what the market was doing back on February 12th, coming away from the short-term bottom that it achieved on February 8th. So again, right here, folks, we were a little disappointed. We were hoping that we'd get a little more work done on behalf of this bull market in terms of purging excesses, and maybe now sending some real strong signals that a trade war at any time, in my view, but certainly at this juncture, would be a very bad thing to embark upon. And here we are getting what we think is a healthy retest, probably, of these lows at least, which, as we said on February 21st, would be totally consistent with the preponderance of past bull market corrections, and not at all just the bull market we're in, but just bull market corrections in general. Okay, so now let's get to a little charting, a little bit of the market technicals, and continue to put the current state of volatility into what we believe is its proper perspective. This is our 5-year daily chart of the S&P 500. This is the one we work off of to do some of the analyses that we do each week to determine whether we remain in a long-term bull market or if we need to be concerned and start making adjustments in portfolios. That all-important 200-day moving average was tested here recently. It may get tested again. Not unusual. In fact, here it is getting breached during the corrections of 2015 and 2016. Here it is in 2014 getting breached as well. And as we zoom way out, here we are in the late 90s. Here we are with the tech bubble bursting in a real bear market. Here we are coming back. You can see all the tests. Notice here during a bull market, these tests are passed and things keep trending higher as long as the trend is in the right direction. In a bear market, we get these rallies, these counter trend rallies, but we're in a bear market and therefore it's not time for the market to break out. When the conditions improve, here we go, and we can see the moving averages move into the right places. That's what the nearer term or the shorter term, faster moving averages on top of the slower. But you can see, folks, volatility during bull markets is absolutely the norm. We had very little. In fact, we had a record stretch in here without any, but we're getting some now, and that's the norm. And as I keep preaching, that's actually healthy in the context of longer term bull markets. Now to zoom out even further and look at a weekly chart and using the weekly moving averages, here we have the 10, 20, 30, 40, and 50 week moving averages. So less choppy, slower moving, so to speak, but very important when we assess long-term trends. So here is the lineup today with the fast moving averages ahead of the slow. It's a very, very bullish look in terms of trend. Here we were during the corrections in 2015 and 2016. Here's the look going into the worst recession since the Great Depression. And here we are in the next worst thing, if you will, when the tech bubble burst at the end of the late 90s. So we asked the question, does this look here look more like this, this, and this? Or does it look like a very healthy pattern as it did here, 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 and here? So now, folks, the weight of the evidence suggests that volatility at this juncture would be volatility for long-term patient investors to ignore. We will continue, as you know, to monitor this very, very closely. And as we see things break down, which we ultimately will, we will then be forced, happily, to make incremental changes within our asset allocation decisions and our sector decisions to accommodate for what the signals are suggesting. And I'm going to show you more here in a minute. But as of right now, this signal looks more like it did at this juncture during the longest bull market in history, which lasted throughout the 90s, which happened to be essentially right here on the timeline. So again, folks, here we are with a similar looking chart. And again, I'm not making any promises. I'm not predicting that we have 3.5 years left to go. But I'm telling you that after even a very nice stretch of gains, the market went on to achieve much, much higher highs with more volatility, much more than the kind of volatility and the pain we happen to be experiencing presently. So as we've talked about here a lot on the blog, we do a thorough weekly analysis of what we consider macro conditions. Our macro index now has 81 inputs. We score it every week, and it gives us a feel for macro conditions, which we think is ultimately the guiding factor in terms of how we treat volatility in the market. We do think the technicals are important. They do give us signals. We do respect them. At the end of the day, we found, though, that we need to have the conditions. We need to have the macro bear market conditions really develop before we get seriously worried about the prospects for something like early 2000, mid to late 2000 bear markets that were quite extreme. And to express why we put so much importance on that macro data, I want to show you our chart of the S&P 500 with some trend lines, the upward trend lines, the downward trend lines for the bear and bull and bear markets that we chart and watch and look for support and resistance. But here we also layered in the results of the back tests of our macro index. So as you can see here in the late 90s, in 1998, we had a huge 20% correction. We had a lot going on. Russia defaulted on its sovereign debt. We had an Asian currency crisis. We had issue with Latin American currencies. And we had a monster-sized hedge fund implode right in here. But folks, we didn't have the conditions for a bear market. So we had a whale of a correction, but something that turned out to be volatility to ignore and that should not be reacted to. Here we are later in the 90s with some volatility, but not the conditions for a bear market. But as we got up in here and as we were hitting and coming off of all-time highs, look what was happening to the macro data. It was negative, and it was telling us that the risk at that time is now to the downside and that this would be volatility to very much respect. Here we are getting some rallies midway through. We still had a very negative setup. But as we began to bottom, as we got in here, suddenly the macro conditions improved, and that's where incrementally a portfolio should start getting more cyclical in anticipation of better things to come. Here are the many corrections between the two bear markets. Here is a pretty strong macro reading that would suggest volatility to ignore. Here we are at all-time highs, however, with the macro conditions breaking down, and so clearly volatility to respect. Here we had a nice rally. I suspect that people got very excited, but no, the conditions were not conducive to gains going forward, and that continued to be the case all the way till actually after the market began to bottom around June of 2009, when the index began to turn green again and began giving a signal that it's time to be very much in the market with cyclical sector allocations. Here we are with the first 10% correction after the market began to bottom. We got close, but we still had, on balance, a bullish macro outlook volatility to ignore. And folks, that's what it's been ever since, even during the 2015, 2016, by the way, worst start to a market in history, corrections. We were not selling this market, or we were not getting notably defensive because the macro conditions were telling us not to. Here we are with this last Monday's report of a 75. A couple weeks before that, we got back into the 60s. You can see in here we were in the 50s. But folks, if you're wondering why we sound, in fact, are sanguine amid the turmoil that we're currently experiencing, it's because the technical long-term factors are still telling us we're very much within a long-term trend. Here's the normal trend line, so there's much more space here that we could break down to. But the macro conditions are also telling us that this is not something to begin reacting to measurably. Now, sector by sector, those of you who had some exposure to a lithium ETF know that we wound our way out of that position recently. We've also pared back home builders a bit in certain portfolios. Not that we're bearish on the home builder sector. We still own it in our discretionary ETF. It's just that with higher interest rates and some stress in that market, the technicals weren't looking so good. So we've made some incremental adjustments there as well. So we will certainly do that. But from an overall standpoint and how we view the market, very open-minded to all possibilities. And we certainly expect that there will be lots of volatility going forward. But again, our analysis is telling us we're still within a bull market and we need to still act as if we are until the conditions begin to tell us something different. In other words, when the chart looks like this, when the weekly moving averages look like this, when the fundamentals look like what I just described, we want to maintain a growthy asset class sector allocation until the weight of the evidence changes. And we need to expect and accept volatility again. Those would be under conditions like these, like the current condition. Under conditions like this, where our macro data is breaking down, where the technicals look very, very ugly, we want to maintain a defensive asset class and sector allocation until the weight of the evidence changes. And we want to really focus on preserving principal during times like these. Imagine if we were acting like this when the evidence was actually dictating that we act like this. What we would have cost ourselves in terms of portfolio growth over the long term. Just as we don't want to act like this when conditions are telling us this. In closing, Jesse Livermore, Reminiscences of a Stock Operator. It is the most important book I think ever written on markets. Regular readers know I quote him quite often. Here he says, "I think it was a long step forward in my trading education when I realized at last that when old Mr. Partridge kept on telling the other customers, well, you know, this is a bull market, he really meant to tell them that the big money was not in the individual fluctuations, but in the main movements. That is, not in reading the tape, but in sizing up the entire market at its trend," which is what I'm illustrating for you here. And right here, let me say one thing. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It was never my thinking that made the big money for me. It was always my sitting. You got that? My sitting tight. It is no trick at all to be right on the market. You will always find lots of early bulls in bull markets and early bears in bear markets. I've known many men who were right at exactly the right time and began buying or selling stocks when prices were at the very level which should show the greatest profit. And their experience invariably matched mine. That is, they made no real money out of it. Men who can both be right and sit tight are uncommon. I found it one of the hardest things to learn, but it is only after a stock operator has firmly grasped this that he can make big money. What he's talking about here, folks, is that smart people who were right on the market got all bound up on the kind of volatility that we're experiencing right now and made decisions that killed them in terms of their long-term success. We're going to try not to do that here, and we'll keep you posted on our thoughts, on our research, on our analyses, and we'll leave it there. Thank you, as always, for watching and listening. I hope you have a wonderful weekend, and of course, there's much more to come. Take care.